What do you think Pandora imagined the moment she opened that box? Did she expect wonder or sense danger? Did she try to slam it shut, or did she realize there was no going back? We all know the story. A box that shouldn't be opened is opened anyway and outpours what exactly? Depends on who you ask. Chaos, challenges, perhaps a combination of good and bad. Today we've opened many boxes, and we are all Pandora. In that same moment of wonder, of worry, of awe, right as the lids crack open. What awaits? Catastrophe, euphoria, or some unpredictable mix of both? Geopolitics. What comes out of the tariff box? Out of the America First and former allies last box? What emerges from the artificial intelligence box? Maybe the most important Pandora's box of them all. In the private markets, the credit box has been opening for a few years. Evergreens, the advent of an entire new group of investors and investment structures. Where does that take us? Where does that take us as general partners and as limited partners? Oh, you're asking, what the hell does Gandalf from Lord of the Rings have to do with Pandora's box? Gandalf was sent to guide and inspire. Think of Hamilton Lane as the Gandalf of the private markets Middle-earth. Come with us as we take a look inside the boxes, as we give you some ideas about what shapes may emerge and what our world will look like over the next year, or 2, or 5. We'll take you there with data and information, with options and insights, and most of all, we'll take you there with a sense of humor and a sense that what we know most of all is how little we know for certain.
So, where are we now? Let's be honest, you are buried in market overviews, and the good news, you can throw most of them out. Skim a couple of the decent ones, read ours, obviously, and boom, you've just reclaimed some time to surf the web. Here's our quick macro view, and it is pretty simple. Listen to the market. We've spent a year hearing warnings about tariffs, inflation, bubbles, geopolitics, pick your poison, but what are the markets actually telling us? Equities in the US and globally are basically saying, relax, everything's fine. No real economic panic in sight. Bonds, though, are less cheerful. Short rates are generally drifting down. Long rates remain stubbornly high, which could signal long-term slower growth. The dollar has weakened and would look even weaker if the yen weren't falling faster. Currency markets are signaling uncertainty. Weakness may be chronic, but it's contained. And before you call us Pollyannas, here's the twist. Gold and metals, they're flashing a warning. Markets increasingly believe governments will spend and inflate their way through crises. That loss of confidence in fiat currencies is a long-term signal we think you should take seriously. And here we are. It's the moment the box opens. Strong equity markets, sticky bond markets, a soft dollar, and the strongest performance coming from gold and silver. These are assets that don't surge when everything looks perfect. So what are we unleashing? Crypto has failed its safe haven test. It's just a bad NASDAQ proxy. Safe haven currencies now come from countries that kept debt under control. Swiss franc, Swedish krona. But is that the future of investing? And the dollar stays the reserve currency because there's no alternative. So we'll admit it. This year's view is more US-centric. But it has to be. We live in a world where only 2 economies truly matter. The US and China. And most investors won't meaningfully reallocate into China. So for now, let's put aside foreign policy and the daily onslaught of geopolitical headlines coming out of the US. None of it screams perfect, but from an investment standpoint, it's still the only game in town. So the question becomes, overweight or underweight the US? Our view? Overweight the US across all assets.
It's time to say the quiet part out loud. The public markets today are completely tied to the AI theme.
Completely. We have 7 stocks driving the entire public market.
You'd have to go back to the 1970s to see this level of concentration. And today, these companies aren't just correlated, they're investing in each other. For decades, investors have been lectured that indexing and cheap is the way to go in the public markets. So how many of you know how much exposure you really have to NVIDIA stock and in how many different places. We aren't saying that AI isn't important. In fact, we are saying that today, and for the next several years, it is the most important. It isn't just fueling the public markets, it is accounting for about half of US GDP growth. Let's step back and remind ourselves, what is the thesis here? It is this: that large language models will continue to grow and scale, and the adoption and usage will bring significant economic benefits, and all of that powers the public markets. Hey, if you believe Elon, we won't even need to be working at all or 10 or 20 years. So if the large language model narrative works as advertised, great. But if some smart critics of that model are right, and they're not as scalable, then the public markets and the overall economy, well, it's in for a lot of pain. And about those humanoid robots doing all of our household chores, hey, we've been dreaming of this since the Jetsons first aired in 1962, and we will still be dreaming for a long while. Meanwhile, the robots that actually matter to your private markets portfolio, they're here now. They're driving industrial and manufacturing plants that can run on a fraction of historic labor. That's worth getting loud about.
In private market, AI is an ecosystem story with participants investing across the entire stack that makes AI work. This is all largely earlier stage and being funded by venture capitalists, with about 50% of all venture capital going into AI-oriented deals. 50%? That sound you hear is a faint echo of dial-up and .com flashbacks. Our view is that early AI era fund performance is mirroring the SaaS era and not the .com era. Revenue here is showing up faster, much faster. In addition, the spend is equity-backed, embedded in everyday workflows, and constrained by lack of infrastructure, not demand. That's very different from the .com hype. But this isn't to say that there aren't any concern. Much of this is early. Winners and losers are largely TBD, and there's seemingly an endless stream of capital rushing into the market. So could valuations cool or crash? Sure. Could AI vanish? Nope. This genie isn't going back in the bottle. For buyout, AI is not an investment story, but an adoption race centered around enhancing go-to-market and pricing strategies, as well as streamlining processes and operational efficiency. Our GP service shows a big jump in portfolio companies embracing AI, but there's still a long tail of not much yet, which is concerning. As a general partner, you're standing at a critical crossroad. AI isn't just a trend, it's a test. It can be your biggest risk or your greatest opportunity. And the difference comes down to one thing: action. The future is in your hands if you start now. 4 imperatives. Pick your bets, deciding where AI matters. Treat your data as an asset. Instrument everything to upskill the front line. And mind the risk. The dispersion of return continues to be wide in our industry. In AI, we'll call that to widen even further. There will be those who figure out how to do both: invest in AI and harness it effectively, and those who ignore it or are too slow.
At Hamilton Lane, we are clearly in the former category. Our tech stack combines proprietary Cobalt data and tooling with partners like Daphne, Canoe, and 73 Strings to ingest, classify, and analyze private markets data. We work with platforms like iCapital, Case, Securitize, Republic, and Pluto Credit to reduce friction in subscriptions and liquidity, with AI embedded across the process. What does this mean for clients? Transparent digital diligence, automated benchmarking, company-level value driver tracking, and faster what-if analysis, all pointed at one thing: making better decisions sooner. And yes, a lot of the analytics you've seen here today, they're AI assisted on our side. We practice what we present. The box is now open, and nobody is going to close it. But now you have choices to make. The public markets are largely LLMs and chips. That isn't really investing in AI. The future of AI will come from the venture capitalists and growth equity players. This is where you need to be. It's as simple as that. How much depends on your risk tolerance. So make a plan, or ask us to make one for you and come embrace the future.
Now let's shift our attention to distributions and valuations.
Starting with distributions, they've been sluggish for the last few years. While 2025 ranks as the second largest year for distributions, this doesn't account for industry growth. Distributions were about 65% of what we would have expected to see. Said another way, they were hundreds of billions of dollars below what we would have expected in a normal market. That's the headline, but what are some of the tangential themes? First, hold periods are extending. That might seem obvious, but it is important to note as there is pent-up value in funds. You can see this in the NAV growth of the asset class. The key distinction is when cash comes back and not if.
Second, valuations are also important to this story. Despite high purchase prices, there is still a bid-ask spread between buyers and sellers. As a potential seller, you can decline to sell, extending your hold period and bringing your valuation under further scrutiny. Or you can agree to sell at current market clearing prices, likely at a markdown. While neither is compelling as a GP, this drives less overall activity, and the exits that do happen are less likely to surprise to the upside. Look at the markup at exit data. This has radically changed over the last few years.
The third big theme is the impact of 2020 to 2022 vintages. A few facts to level set here. First, the asset class is overweight these vintages. On a combined basis, they represent 25 to 30% more NAV than average. Second, these vintages largely paid up to deploy capital at a time when interest rates were rising. And third, this cohort of funds looks remarkably similar to market averages in a number of common metrics, except for one. Distributions to date are lagging and resemble funds raised in 2005 to 2007. Typically, not the comparison you want to hear.
So what does it all mean? First, 2020 to 2022 vintages will play a critical role in private market performance. Unfortunately, we predict that performance will disappoint. Over-concentrated, overpriced, and longer hold periods, any way you slice it, this will lead to lower IRRs. Second, the bid-ask spread is critical to opening up activity. While still early, it looks like buyers are blinking and coming up to meet sellers. If that trend continues, expect to see markups at exit come back. But if we are wrong, deal flow will remain limited for longer, or sellers will need to take markdowns. And third, don't expect a surge in distributions overnight. We are confident there is a lot of pent-up value to be sold, and that distributions will continue to trend up. However, we don't think it will be a quick flip to clear the pending logjam of potential activity. Instead, we see a gradual increase over multiple years.
And now for what we are all really here for, performance. That is, unless you've been a private equity investor looking to beat the public markets over the past 3 years. Now, warning, this section is focused on equity, given the attention its performance has received. But first, we really should point out the strong performance in infrastructure and credit. Both strategies perform relatively well in higher inflationary and volatile periods, and they've certainly done their jobs over the past 3 years. Now to equity. If we look at rolling 3-year performance, we can clearly see private equity has underperformed public benchmarks of late, with a very concentrated AI push driving almost all of the public outperformance. Of course, 3 years is a relatively short time period, so let's look at rolling 10-year periods. Paints a very different picture, doesn't it? The underperformance of private equity versus S&P occurred very recently, and the outperformance against the other benchmarks remains. And as you can see, there have really only been 2 short periods of underperformance prior to this, and those were followed by periods of strong outperformance. So, what follows this period? Well, the odds here do not look great for the public markets. This chart is showing you that when forward public PE ratios soar, subsequent 5-year returns come way down. The cluster of dots hovering above that orange diamond represents the trailing 5-year returns we experienced up to this year. Do we really think we can continue to see significant growth alongside these extreme PE ratios? The data suggests not. And when forward public PE ratios are higher, and yes, we're at the tallest bar there on the right, the historical data tells us that private markets outperform publics substantially over the following 5-year periods. So, what's to come over the next 5 years? Well, we would argue that the recent outperformance by the public markets is unlikely to continue.
This is probably a surprise to no one watching the private markets. Fundraising is slowing. 2025 was likely the 4th consecutive year of decline. I'd highlight, particularly for those worried about the private markets getting too big, what a tiny percentage they are compared to the public equity market cap. What may surprise you is that deal activity is not down, it's up. Hamilton Lane's deal flow may provide some clues. Our co-investment deal flow is strong, as these dollars are supporting the general partners to achieve that increased deal activity. Secondaries are also strong. We're seeing multiples of what actually clears the market. The real decline is in primary funds. So does this decline in fundraising signal a shift in the GP landscape? We don't think so. See, there's no survival of the fittest in private markets. GPs hang around. We also don't see a wave of GP consolidations on the horizon either. So what's an LP to do? Focus your dollars. Support the best GPs. Here's what mattered to LPs in 2024, the combination of performance and liquidity. So what should investors expect in the year ahead? Well, fundraising for closed-end funds is likely to remain tough until distributions and performance improve. And we'd anticipate continued strong deal activity as capital flows into the asset class in other forms. Think evergreen funds, secondaries, and those co-investments.
Cockroaches. In a year where the cockroach became synonymous with private credit and the threat of a credit bubble became the prevalent force, we say think again. 24 years of historical outperformance is impressive, and this year private credit is truly our portfolio champion. The private credit market has been resilient, spreads have rewarded you for being in private credit, and the wallet share in private credit deal making is significant. And whilst overall deal pricing has continued to rise, the rise in credit contribution has been more constrained, leaving a huge equity cushion to protect those credits. Yes, the market is changing, and for us that's happening in 2 broad ways more than ever before. Number 1, the big guys are getting bigger, and if you don't have scale today in private credit, you maybe never will. And number 2, we may finally have found a part of the market which is truly disruptive. During the past year, capital flows to private credit were more commonly into evergreens than any other structure. I know what you're thinking, surely Hamilton Lane, there must be a catch. Will regulators chase private credit away? Under the current deregulatory environment, we don't think so. GPs must simply know that governments, regulators, and market commentators are looking harder than ever before. To investors making portfolio decisions, we leave you with this. Private credit is and will remain an important part of your portfolio. And if it's not, start planning how to incorporate it.
If there's one box in the private markets that's really shaking things up, it's the evergreen funds.
The single biggest reason investors are flocking to evergreens is pretty simple. They're easy to use. In a world where customers prefer simplicity, that matters. Think about Robinhood. It blew up because it made investing feel accessible, with easy-to-use trading tools and low barriers to entry. Evergreens are the Robinhood of the private markets. Prior to evergreens, investing in the private markets was, well, let's be honest, a hassle. It put a lot of the operational tasks on the investor, but evergreens change that. They shift those burdens to the manager. And trust us, handling them is no easy task, which is why we have a large team dedicated to these efforts. But for the investor, the experience suddenly becomes much easier. Is the evergreen structure the perfect answer for all investors? Of course not. Investors of all types and sizes have their own preferences. Some may prefer the wider menu of managers you get in closed-end funds. Others may already have the infrastructure in place to handle the complexity, making simplicity less of a priority. But many of the objections raised by skeptics of evergreens have already been disproven. You've likely heard some of them. Evergreens use secondary investments to boost return, which isn't sustainable, or evergreens sacrifice return. Those are fair questions, but the data is clear. Across both the 1 and 3 year periods, evergreen funds have actually outperformed closed-end funds.
Taken together, these criticisms point to something more important: a structural change in the way individuals enter private markets. What they really point to is a fundamental change in how individuals and their advisors can access private markets. For years, getting into alternatives meant navigating complexity, high minimums, and long lockups, often putting them out of reach for many otherwise qualified investors. Evergreen funds are changing that equation by wrapping institutional quality investing into a structure that feels far more accessible and usable. Another big difference? Unlike traditional closed-end funds, evergreens are designed to be semi-liquid. They are not public market substitutes, but they do give investors a path to access their money over time, rather than being locked up for a decade. Think of it less like a checking account and more like a long-term savings plan with scheduled access points. That measured liquidity has many benefits, and one of the most important being that it helps investors from panicking and selling at exactly the wrong moment. And then there's scale. In an evergreen world, scale really matters. Larger, well-resourced managers can build the deal flow, infrastructure, and risk management needed to invest through cycles, helping smooth the investor experience and support more durable performance. But scale cuts both ways. As evergreens explode onto the marketplace, investors should be wary of managers chasing asset growth for their own sake, rather than focusing on disciplined underwriting and long-term outcomes for clients. Lastly, evergreens are changing how we think about valuations and manager selection. Features like high watermarks, ongoing performance fees, all increase the focus on how assets are marked and when they're sold. In a more bifurcated world, the winners will be managers who can truly deliver in an evergreen format, offering practical liquidity, disciplined valuations, and access to private markets that align long-term portfolios with long-term goals.
At this point, all the negativity around private markets must be ringing in your head. Fundraising is dragging, exits are rare, and private credit is just doom and gloom. What could possibly save us? Secondaries, of course. Secondaries to the rescue! The secondary market continues to post record levels of activity, providing private market investors the much-needed liquidity and optionality they've been looking for. 2024's record $160 billion of transaction volume was eclipsed in the first 9 months of 2025, with the full year totaling $240 billion. Continued strong performance has driven an influx of capital from both closed-end funds and evergreen vehicles, with investors eager to add more secondary exposure to their portfolios. Too much capital? Not even close. The supply-demand equation still points to an undercapitalized market that favors the buyer. Pricing of secondary LP interests has improved marginally over the past year, and LPs are increasingly opting to trim asset exposure through secondary sales versus waiting for liquidity the old-fashioned way. As for continuation vehicles, nearly every GP is engaged in the market, some in more ways than one. GP-led deals are good assets. They've already shown strong performance before moving into a CV, and performance of CVs relative to regular deals offer similar results with much better downside protection. It's no surprise investors are leaning in. Adding fuel to the fire, GPs are even trying to raise their own secondary CVs now, albeit with mixed success to date. We are in the early innings of an exploding market, one that no doubt is changing the landscape for private market liquidity. So what's the punchline? Secondary tailwinds are stronger than ever, and most investors are underallocated to this market. So grab your shield, join the charge, and let secondaries lead you to solid ground.
The pace of investing right now is pretty close to long-term averages, though in absolute terms, 2025 is on par with 2022, and only a bit below the peak in 2021. In buyout and credit, it's almost identical. In venture and growth, just a bit higher. If we look at time to deploy, real assets are right around average, about 2.8 years. Venture is lower, but buyout and credit stand out, suggesting that this could actually be a good time to lean in. And why, you ask? Because historically, slower deployment periods have been stronger vintages. Now, purchase price multiples, yes, they're high. They've been climbing. They never really dipped in 2021. Is that necessarily a bad thing? We don't think so. For many investors, price is the only indicator they use for future returns. Price is going up means returns must be coming down. But that logic has not played out over the past 15 years. So what happens next? Most GPs we surveyed expect multiples to stay flat. Not up, not down, just steady. And in private markets, steady can actually set the stage for opportunity. We'll keep watching, but the message is pretty simple. Stay patient, stay selective, and don't sleep on buyout and credit.
So here we are once again, just us and the box. This market has already unleashed its share of surprises, some leaving us puzzled, others full of excitement. What remains is the one thing investors need most: clarity. So let's recap the key points to keep top of mind in the year ahead. First, the debate is over. Private markets consistently outperform over the long run. They are more diversified and provide broader access across sectors, which is important as the AI wave continues to grow and broaden. Second, massive data and improvements in analytical tools now allow for more credible interim valuations and better portfolio construction. Just look at the booming secondary and evergreen markets. Investors can now confidently allocate more capital to private markets than ever before. The result? The current monomaniacal focus on distributions or lack thereof won't matter as much, since you will be able to get in and out of private investments more easily. Weaker funds will find it harder to hide. Poor performers will wither and fade, leading to even better median relative returns across private markets. You say that private markets have had their day and now the game is over. We say these asset classes are proven and current trends will only enhance their appeal.